I know you're waiting for it, and I know you know that it's coming. Nvidia earnings are just over a week away, and I have my Nvidia stock price prediction and Nvidia earnings projection in the works coming out for you Wednesday after the market closes on the 21st of August. It's the 28th of August after the market closes, so 1 week in advance of those earnings. You'll see that hit YouTube, so be on the lookout for that. Make sure that you subscribe. What I'm bringing you today is a scenario that somebody presented me in the comments in my YouTube video, and I get asked a lot with people who have a lot of shares out there of different companies, like, what do you do when earnings comes around? So I thought that this was a teachable moment where I could talk about some different choices that do happen to exist. And I thought that this very specific scenario was really nice to talk about with you. Now, this individual did make it a public statement. And I said, since you already made it public, can I make a video about it? And it's not financial advice. It's in the spirit of education. And, that way it just lets people know what sort of choices exist to them in the markets. So I got the permission, I got the green light from them. They said, sure, go for it. So here it is. And if you're that person who requested it, I hope that you enjoy. Guys, let me know down in the comments what you think of this video. So Nvidia stock, weighing choices before earnings. This is a true story. Earnings can be a coin flip. Now, this specific person has 1,444 shares of Nvidia. Now, mind you, they disclosed this after the market closed on Friday. So it's about $124 a share. Now, their cost basis is 116, so they were already in profit territory. They are at nearly 100% margin, which means that they're borrowing against the shares that they currently have. They're almost the same amount as what they have. So they told me it was a $90,000 account value, which means they're borrowing about $90,000. So that's called leveraging. And while it can be great for profit, it can also be pretty darn risky to do if the stock price should happen to drop instead. Then you can get kind of stuck holding the bag and getting a margin call and everything. So the risk of margin call is there. And then also you're paying interest pretty much on a luxury automobile at that rate, $90,000 worth of a loan, and you most definitely are being charged. That's going to bleed away your account value and put you even closer, even at more at risk of that margin call happening. So just a real quick idea of what's happening when you do take that leverage. So I got here some $20 bills, and let's say you have an account value of $20, and so you have $20 worth of stock in that portfolio, and that means that you can borrow another 20. So you cash in and you go up to that $40 worth of stock. Well, let's say then that doubles. Now you have $80 worth of stock, but you borrowed 20 of it, so you got to pay that back. You now have $60. So you had 20 at first. If you double that, it would have given you 40. But since you borrowed an additional 20, you now have 50% more cash than that 40. Now you have $60. So you went from 20 up to that 60. So that's 3 times your money just by using a little bit of leverage. Now that's a very rosy scenario. Sometimes that happens, but imagine that you borrowed 20 and then how much it went, got cut down to only worth $10. Well, you still owe that $20. Now you're $10 in the hole and you don't have the equity to cover it anymore. That person's going to come knocking for that full $20. That's a margin call. You don't want to see it happen. So just to put that out there. And like I said, there's interest rates on it to it. And it's not just, hey, you pay back what you borrowed. It's, hey, you pay back what you borrow plus interest on top of it. And that interest does accrue, I think, on a daily basis, but you'd have to check with your brokerage or your trading platform, whoever it is that you're going through. They'll have their own policies and they'll have their own rates that go along with it. I think it might be a daily charge. It's at the very least a monthly charge. So let me put this back up here for you. And so here's what I see for those choices. You have holding versus selling. You have selling covered call options and buying protective put options. And it can really be any combination of what you see up here. They're all choices that you could do. Remember, none of this is financial advice. And let's move on to the holding versus selling. You have the choices. All or a partial sale. Do you just liquidate? This person is probably making about 20 grand just from yesterday's close, just so you're aware of that. At that 130, it's about a $20,000 gain. Cash it all in. Yeah, you got to pay either short or long-term capital gains tax unless you have a tax privileged account such as a retirement account. Then that can be different, but you'd have to talk to a tax advisor or retirement advisor about those sort of implications. But just in a regular trading account, you're not going to get those advantages. It can reduce your market. It can reduces We're going to change to say can reduce. There we go. Mind you, it's 3:40 in the morning as I'm doing this. I have about 15 hours worth of work into this presentation. Not the keynote here, but the actual numbers part itself. So wait until you see. It's pretty crazy how well it all works together. And then I already mentioned the taxes that you could also pay on this for any of those shares that you happen to sell, depending on how long you held them, could determine if it's short or long-term capital gains tax. So selling covered call options is another choice that you have. You do get an upfront payment because you're selling something. You do risk bag holding. Imagine that we go from 130 down to 70 following earnings. Well, there's probably going to be a margin call that is involved with that. And then you're also stuck holding a whole bunch of shares that are worth far less than they were before. That's one of the risks with selling covered call options, is that risk that the underlying security, in this case, the Nvidia stock, should happen to plummet. And this isn't bagging on Nvidia at all. This is just stuff that can happen with covered call options. So you also have assignment risk in there, which means that when you sell the covered call, what you're doing is you're agreeing to sell your shares of whatever stock, in this case Nvidia, 100 apiece per every contract that you sell. And you could be assigned to sell those off to whoever bought the contract from you at whatever price you agreed on, as long as you're at or above that price by a given date. If you don't know options, you can check out the link down in the description for the trading course. Also, the link down in the description for the Patreon. I have a beginner options that you can go and you can check that out to explain more about it. So let's move on. The risk of opportunity for more cash. So by writing the covered call option, let's say that you cap that price at 140. Well, then you can only get up to $140. You will only get $140 per share if you get assigned to sell those shares. So if Nvidia stock price goes up to 200 instead, you missed out on that $60 change from 140 up to 160. You just can't capitalize on it. So selling covered call options, you do get that payment up front. It can help reduce your margin. It does give you more money to trade with, but then you are kind of locked into it as well. But then you also have opportunity risk and risk of bag holding. So those are some other considerations that are out there. Now, for buying protective put options, it will cost you money to buy them. So it's going to mitigate loss, but you're going to sacrifice buying power, and they do lose value over time. So depending on how aggressive you are, how short term you went with those options, it could get you a smaller premium, but you risk greater loss with those nearer term options. So there's a lot that goes into that, plus moneyness also weighs in. This is not a video on options. We can really get into the weeds with them. This is just talking about choices that are out there, making you aware of what sort of tools we have existing. And then I have one more slide, but I'm going to save that to the end and show you what I would do in this situation. Again, not what you should do, but what I would do if I was this person in this situation. All right, so check out these numbers that I have for you. 1,444 shares of Nvidia, cost basis 116, total cost of owning them $167,000. Their account value is $90,000. That's because $89,000 of that is a margin loan. So the equity value currently is $179,000 for their entire account. That's just in equity. That's just in whatever stocks they happen to own. In this case, Nvidia, $90,000 of that gets subtracted from the equity value, though, because of the margin loan that's out there. 99% margin, just dropping down to $123 per share, puts them in margin call territory because they have more of a loan than they do value of the stock. So that is something you can see at the 88,000 versus the 89,000. So the account value, there's just not enough there to cover how much the loan is for. So you can think of the collateral running out, so the bank comes calling. In this case, the brokerage comes calling. So the last close that you see up here, the last close was actually 130, which actually puts them in better position. They're actually at 90% instead of 99 that they were at. But remember, we're in volatile territory. That can easily go. That's still a lot of margin to be in, just so that you're aware of those things. And we can easily see that change in a day to put them back in margin call territory, which then you either get liquidated or you have to add more funds to your account, or you have to sell in order to bring that margin loan back down into something that's less than how much your account is worth. So just talking about it in simple terms, let's move over to, let's say, just selling the shares. So if you sell, we'll just say 444 of the shares, so you're keeping 1,000 of them, that actually drops your margin percentage down to 32%. So if you're somebody who uses margin, now you're at least under 50%, you're at least in a more reasonable territory. You have far less risk of being liquidated for something like that, getting margin called as a result of it, and you're still sitting at 26% profit. That's assuming that the 1,000 shares remaining are still at $130, even though it's unrealized in terms of profit. So it's a simplified example. It's not going to have the dynamic nature that the market will, but this does serve the purpose for example, and it serves it pretty well. So if you instead choose to sell 1,000 of those shares, that left with 444, notice your profit didn't change, and that's because we're still assuming that the shares that you have left are still worth that same amount, that 130 that you sold the others for. But that also takes you down to margin balance of 0. Now you actually have a cash balance of almost 41,000, which means that now you can take that and you can use it elsewhere for other things if you were to do that. So that's one of the choices that you get. Now, mind you, if you go closer to like 700 shares, getting close to about half, you have a small cash position. You have $2,000 of cushion, and you have all of that margin to use, which at this point in time is about $98,000, $99,000 worth of margin at your disposal, which isn't so bad. So that's something very much worth keeping in mind, that you don't have that risk anymore. Now the shares that you have left, the 744 that are left, are sort of free and clear. Just to hold on to and do whatever with. So that brings me to selling call options. So let's say that for selling those covered calls, you sold 700 shares. That means you have 744 left, which means you can write 7 contracts. Let's say that you went with the 130 strike on August the 30th. If you don't know options, just pay attention. You're selling something, so you're going to get cash for doing that. It's called the premium. You're going to get $740 per contract, which gives you about $5,000. Check out your profit. You went from 26% not doing it to 32% profit. So you're amping up your profit. And so you're like, man, I should do that every time. That sounds great. There are trade-offs to it. You capped yourself at $130 per share for 700 of your shares. You don't get more than that. So if this share price instead, it goes up to 160, you'll notice you went up to 81% profit here for just selling the shares outright. But you'll notice with the selling the covered calls, you're only at 61% profit. It didn't move nearly. You now, that's called opportunity cost. The opportunity to make more money has slipped you by. You just didn't get it. Now, in terms of the downside, let's say that instead you went down to $100 per share. Well, because you sold some of your shares, you're still in loss territory for something like that, 29% loss for just the shares. But when you sell those calls, because you got some cash for selling those calls, you didn't lose as much cash there either. Now, let's say it's not so drastic. Let's just put it to the 116, which was what their cost basis is. Didn't make anything, didn't lose anything, just with the shares. But when you look at what they got for selling the covered calls, there's actually a 7% profit there. Now, there is a break-even point, and it's the 130 strike price plus the 740 contract premium. So when I set this to 137.40, you'll notice either way, it's $30,902 in profit, which comes at the 39% profit. So that would be what you're looking for, is that if you don't expect that price to go up over 137 following earnings, for example, if you're relatively confident that there are times that it could make sense to sell those covered calls. So it does offer some downside protection, but it also limits your upside. So those are some trade-offs that you have, and it can leave you bag holding if the stock tanks instead. So the other thing that I have for you is buying protective puts. 130 strike, but now it's about, since they're put options, it's about the price dropping. So at or below 130, you could have the opportunity, since you're the buyer, you would have the opportunity to just sell your shares off to somebody else at $130 per piece if the stock price is at 130 or below. And that's by August the 30th. Our earnings are on August the 28th, by the way. Contract premium as of yesterday was $7.30, which comes out to $730 worth of premium, but you're buying them. So you're actually going to have to pay that, which means your premium is going to cost you. It's going to cost about $5,000 worth of insurance. You can think about it that way, but you're locked in at 130 being the lowest price. If it's up above that, if it's up at 170 after earnings, you're good. You paid $5,000 for insurance and then you just didn't need it. And that happens with health insurance, car insurance most of the time. Most of the time you don't need it, but it's there for the times that you do. So that's what buying protective puts does for you. So what does it do? Well, where you would have made 39% under this scenario at that $137.40, you made 39% on your money. Not bad. With the protective puts, you only make 33%. So you make a little bit less money, but they're called protective puts. So instead, let's say that this thing goes sideways and now we're down to $90 per share. Like, earnings were just not great. You lost 48% of your cash without those protective puts. With those protective puts in place, yeah, you lost cash, but you only lost 19%. Still a thumping, still going to hurt. You did not get yourself margin called. You didn't get liquidated by any means. So that would be an extreme scenario that you would have, but because you had that downside protection, you mitigated the loss with those protective puts that were out there. Now, something that I don't have this constructed for, but I could with a little bit more development. Like I said, I got about 15 hours in the creation of these materials and in preparation for this video. So that hourly charge on that, this thing I hope pays off in dividends for those of you watching. Just for those ideas that are out there, feel free to support the channel using the links down in the description. YouTube memberships are on their way, by the way. One thing that you can do is you can actually combine selling covered calls with buying protective puts. I don't have it prepared here, but imagine that you sold something for $7.40 and then bought something for $7.30. So you would actually kind of keep yourself protected in there. As a matter of fact, what you could do is you could go do something like go up to $140 here, and that's going to make this a cheaper premium that you don't get as much for selling this. I think you get, I'm just going to make up a price here. I'm not going to take the time to look. Let's say that it costs $4.50, or that's what you make on each one of them. Yeah, you're going to make less money. And let's say that you, for this one, that you're going to go with 125, and that because you're farther out of the money for this one also gets cheaper to buy. We'll say that this one comes out to be something like $550. So $5.50 for the premium that you have. Well, that means that for every contract, you're selling it at $4.50, you're buying at $5.50. So that's a $1 difference, but per 100 shares. So it's only costing you $100 for that insurance that you're not going to take less than $125, but you're also not going to make more than $140 per share. And that would expire as of August the 30th. So that would be a way that you could insure on both ends, that you would have a little bit more safe, that make it cheaper to buy those protective puts. But like I said, then you put limitations on. I will say that there's always a balance that you're going to find between risk and reward, and there's never going to be any ultra optimal way that you can structure it so that it's only win all the time. If you could, the market would do it already. You can't. The market doesn't do it. I don't have the hubris to pretend that I know better than a lot of the professionals that are out there. I do know a lot about this stuff. I can share a lot of this stuff with you. I am going to start offering trainings on technical analysis, but I'll also talk options with you guys anytime that you want to, and I can talk strategy with you. I can't tell you what to buy or sell. I can't do portfolio reviews, but I can help you bounce around ideas. I can help you to look what to look for in the markets, look for what's on the charts that are out there. Those are all just things that I wanted to offer out there and share with you. All right, so I said that I would share just that last slide. So here's what I'm thinking for something like this. If I found myself in the same situation, and I'm going to say it again, once again, not financial advice, not ever will you find it here. So what would I do for myself? Definitely not advice for others. Well, for me, I would sell at least 25% of my position before the earnings. As a matter of fact, while it's up where it's at right now, and while I have a good price point leading up to those earnings, because earnings are always a coin flip. I don't care how good the company is. It's still going to be a coin flip. Still a lot of risk that goes into it. We don't know all of the machinations that happen within the market. So I'd sell at least 25% of my position outright to reduce margin risk. Actually, I don't really care to be in margin. I'd rather be in cash, especially right now. I'd probably take that to zero if it were me. But this is just some thoughts to be a little bit balanced with, because some people do like margin, some people don't. So this kind of put us right in the middle. Sell at least about 25% of my position. I would sell covered calls against about another 25% with a strike price above the market price. And then I would also buy some protective puts using the premium from the sale of the covered calls, but above my cost basis. So what I'm doing is I'm guaranteeing that there's some profit there for me. I'm doing a couple things. One is that I am cutting down on that margin loan because I'm paying interest on that, and that's going to thump me. That's going to really hurt to be in that margin, and I don't want to be in that margin. I certainly don't want to get margin called. So I'm going to cut down on that margin. I'm going to sell covered calls, which is going to limit my upside, but it's not going to be for all my shares. I'm still going to keep some skin in the game for probably about half my shares that are out there. So that half those shares are just going to be mine, just free and clear. So if I get assigned to sell those shares from the calls, okay, well, I still have skin in the game with the rest of the shares. With the puts, if things tank for Nvidia, and then while I have the puts there for that insurance on the downside, and they were cheaper because of those covered calls, which are now worthless. So maybe that makes a lot of sense. Maybe it doesn't make a lot of sense. I know that this was kind of a dense video that was out there, but I did want to share my ideas. I wanted to share what some of the numbers look like and how some of the movements happen. I can make this document available. If you guys would be interested in seeing something like this available to you, just let me know down in the comments and I can put it out there where you can sort of play around with it and mess around with the numbers and see how it changes things. And if you guys like this video and like to see more like them, let me know that too. If you want to support my channel, help me out for the time that I put in, that my family sacrifices for this, I would really greatly appreciate that. You can talk with me and my community members. You can see my buys and sells by using that link down in the description for the Patreon. Come on over. We'd love to have you over there. Plus, I put out my technicals over in Discord before they ever make it to YouTube. So just so that you're aware of that as well. And then there's a link for a technical analysis trading course. Make sure you use the code word doctor in order to get that massive discount that's available with that. Guys, thank you so much for watching. I really do appreciate it. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.